CapitaLand Integrated Commercial Trust FY 2024 financial results dated 5th February 2025. We'll look at the key highlights. Right, DPU and NAV per unit higher year on year on an enlarged total unit base. Right, so even though they distributed more units, right, mainly to get money to buy Ion Orchard, right, per unit DPU and NAV are still up. Right, so that means that even if you didn't participate, right, you benefited from increased DPU and NAV. Right, so everybody is happy. Higher committed occupancy rate, that's good. Positive rental revisions across both retail and office side, although we'll see office side does have some concerning numbers. Right, AEI completed, right, nothing much to say. Of course, Ion Orchard is the biggest story this financial year. Right, the addition of Ion Orchard to their portfolio, it increases their exposure to downtown retail and deepen their presence in Singapore. Clearly, this is a growth engine of the REIT currently, as you'll see in the numbers later. Right, but this comes with its associated risks during downturns. Right, Ion Orchard should be more affected than the rest of their portfolio. Right, the divestment of this property, 21 Cloyer K, has been used to repay debt, which results in lower aggregate leverage. Right, we look at the overall portfolio performance. Quarter on quarter, everything is positive. Year on year, actually, is down 0.6 percentage points. Not a big deal. All right, mostly it comes from the office side, which is down 1.9%. Right, retail and integrated development are doing fine. Right, if we look at the retail portfolio, rental revision is up 8.8%. Office is up 11.1%. Both are doing well, right? Considering that inflation is, I think, 5%, maybe less, right? So as long as these numbers are above inflation, I think the REIT is doing well in general, right? Tenant sales looks actually not that great at 3.4%, right? I think this is, my guess is this is around inflation or below, but actually the story is worse than this because the devil is in the details, as we'll see later, right? Shopper traffic is boosted by a lot of one-off events, so I don't think this is actually a very important number to track at this point. Right, occupancy cost is 17.1%, so I think there's upside for rental revisions still. Right, not going to worry too much about the AEIs. Right, positive results as a whole for the financial year. Revenue is only up 1.7%, but their cost control is good. So operating expenses is down 2.5%, which means net property income is up 3.4%. Right, distributable income is up 5.1%, and DPU, which is the most important thing we care about as investors, is up 1.2%, right, which is very important in a year whereby most, I think, REITs struggle to actually even maintain their DPU, right? Most have gone down, right? Leverage is down slightly because of the sale of the property we discussed earlier. Cost of debt, I believe, has stabilized because 6 months ago it's 3.5%. 3 months ago it was 3.6, and now it's still 3.6. So it looks like it has stopped going up. Right, borrowings on fixed interest rates is very high at 81%, so they won't benefit as much from the floating interest rates dropping when interest rates drop further. Okay, so this is the not so good part, but they chose to be predictable, which we can respect. Right, in terms of valuations, all right, at the end of the year they do a valuation, revaluation, I would say rather. Right, retail side is very strong, right? Revalue up by 26.7%, right? So it's really good revaluation. It's like everything grew by 25%, more than 1 quarter, right? So this is very impressive. Office is weak, down 6.4%. It looks like Singapore has an office vacancy issue now, right? Even MBC with Mapletree Pan Asia is actually not performing so well. Integrated development is okay, up 2.3%. You can see Singapore carries the portfolio by geography, right? Germany is okay, Australia is dragging, right? This is overseas portfolio is about 5.5% currently, right? I think because of the revenue we'll see later, right? I think the percentage here might drop further in the near future. And that means I expect Germany and Australia as a whole probably to revalue downwards, right? Given their revenue contribution, right? Second half financial net property income is up 1.3%. Right, you can see again retail and integrated is doing decently well. Then office is the issue, right? It's actually down. Right, the whole financial year, right? You can see versus the last financial year, more or less the same story lah. Office is down, okay. Retail is up. Integrated development is up. right? Yeah, so office is the main concern at this point, I believe, right? You can see in terms of revenue wise, Germany and Australia are actually 4.3% only, but somehow their uh, valuation is 5.5%, right? That's why I expect this 5.5% valuation to drop, right? So not very optimistic about their overseas properties, right? Contributing so little. DPU you can see is sort of flattish, right? So second half not as good as first half, right? First half actually went up, right? Not going to talk about this, right? Currently the NAV is $2.09, right? Current price around 194 to 195. I think the discount is about 6% or 7%, just off my head, right? So what's the reason for the discount? Possibly the office weakness, right? Possibly the overseas portfolio, right? I'm a little bit tempted at $1.91, right? But I decided not to add to my position because I think CICT is my top 2 Singapore position already. So just for risk management sake, I don't really believe I should add more. None of which is financial advice, right? Leverage is good, is down, right? Borrowings is down, we're happy, right? Interest coverage ratio is up, right? 3.1%, that's great, from 3.1 times, right? From 3 times previously, right? And cost of debt looks like it has peaked, 3.6. Like I said, around June it was 3.5%, right? Yeah, office is just a concern, not much to say else about these things. Right, so retail's renegotiation here is hopeful that this can again increase the revenue contributed, right? Office side, there's I'm not so positive about the office side, right? It's a bit of a question mark whether they can get good rental revisions or not, but it's possible that their office vacancy problems are only localized in certain areas. Hopefully that 5% is just that 5% doing badly and the rest of the portfolio is doing well, since actually they get 11.1% rental revisions when they do get rental revisions, right? Right. I don't think this one too much to say about. Nope, skipping this. Right, I think yeah. So yeah, retail side is rental revisions is pretty good across the board, right? Not going to say too much. It's just good, right? This is the part where it's a bit scary, right? You look at the 3.4% year-on-year increase, right? It looks good, right? Until you read the details here. They said that this is if we exclude, okay, this 3.4% is including Ion Orchard, which means that and they say here without Ion Orchard, the tenant sales for the retail portfolio and downtown mall actually decreased approximately 1% year-on-year. So I read this, I was quite shocked that actually this one will be minus 1% year-on-year if not for Ion Orchard. So Ion Orchard is a big booster to their retail sales there, right? So the rest of the sales across the board isn't doing very well for the retail side, right? And downtown malls will actively manage to navigate challenging market demands through strategic new talent acquisitions and unique event programming. When I look at these sort of things, I'm not very happy about it because this reminds me of what Mapletree Pen is doing with the Hong Kong Mall Festival Walk. They always say they have to do a lot of funny things to keep the market demand there. Yeah, so I don't like it when I see this, right? So downtown malls may be facing some issues. I'm not sure what, or even though the rental regions look decent, right? So yeah, from what I read here, it looks like yeah, overall is decreased 1% year-on-year. So yeah, I thought it was downtown malls decreased 1%, but I think this statement here refers to overall decrease by 1%. So pardon this error, just ignore this 1%, minus 1% here. Right, shopper traffic, they say there's a lot of initiatives lah, so it could be just due to this one-off initiatives, right? Again, yeah, so if you take out Ion Orchard, this 8.7% will actually be 4% for the retail mall side, so this will be 4%, and downtown malls 8%, right? So this one will be 8%. Okay. Yeah, so I think this downtown mall includes Ion Orchard, which yeah may be slightly elevated by Ion Orchard lah. Okay. We look at this top 5 trades underpin positive performance. So looks like the tenant sales, jewelry and watches seem to be discretionary spending to me, right? Hobbies as well, right? So I'm not sure how this will sustain itself uh, in terms of recession, right? So yeah, these are the high contributors this time round, right? And I think this mostly come from Ion Orchard, because if I look at the last round, right, this is third quarter, right? You look at third quarter results, it's actually not that nice. You look at this is third quarter, and this year to date September 2024. So this one is without Ion Orchard. Downtown malls was minus 1%. Yeah lah, so correct lah. Downtown malls was minus 1%. So the effect of this 8.8% is upwards is mainly due to Ion Orchard lor. Right, this full year, right? Look at the year to date September 2024. Right, so you can see that actually it's not good. Right? And yeah, it will be minus 1%. That means fourth quarter is even worse than third quarter, the first 9 months. If we take out, we strip out Ion Orchard. So this is just something that is quite worrying. Right, anyway, moving on. Right, so I think this is also Ion effect. You see, because this one did not appear in the third quarter case. Yeah. See, there's no jewelry and watches, right? Jewelry and watches here, you know. See. So the full year suddenly gets spiked up from here. It's just Ion effect. It's just from Ion Orchard, right? Based on my interpretation of the information given, right? So anyway, I don't think I'll talk too much about the rest, right? So basically, I think the mall is generally speaking is pretty safe. It's a pretty safe REIT, right? There are a couple of course REIT. Nothing in business is purely, nothing in the investing world is purely safe lah. Right, you tell me there's another COVID, then obviously CICT is going to get in trouble, right? And obviously, if there's a big recession, also they'll get into trouble, right? So yeah, there's no investment without risk. Please do your own due diligence before investing, right? I'd just like to say that I think, yeah, as I said, I'm a bit tempted at 1.91. If I have no position, I'll consider investing. However, this is not investment advice, right? If you have listened thus far, do give me a like. Alright, I think with that will be the end of the presentation. Okay, goodbye.